Hey everybody, welcome back to another portfolio update. In this case, we're talking about the month of June of 2025, and there were plenty of things that went on this month, and some of them will probably surprise you. We're going to see how much dividends we got in this particular month, and this month was absolutely huge. So last month, the portfolio was sitting at $351,687. And every time Trump opens up his mouth, it seems to affect the markets. But despite all this, from the beginning of the year until now, the portfolio has bounced back, and I'm happy to say that we're sitting at $367,467. My name is Darren. I'm a regular Canadian who didn't start investing until I was 50. You know, I used to think it was too late, but I started investing anyway. Now, whether you're 45, 55, or even 65, this channel is proof that starting late works. And today we're going to go over some of the metrics using a couple of great tools that I like to use to show how the portfolio is performing. For those of you who've been following me for a while, you can use the chapters at the bottom that'll allow you to skip back and forth to look at some of the parts of my portfolio that you'd like to see. And if you're new here, I've set a goal of $500,000 before I retire. Now, of course, for some of you that are younger that are watching my channel, that will be completely different because you're starting out younger. But if you're older like me, I think it's reasonable to set some expectations of how much you want before retirement. I'm proud to say that we're 73% of the way there. Now, that goal was meant to be achieved over that 8-year period. You know, I'm going to retire when I'm about 60 years old in about 8 years. But at this pace, we are probably going to outpace that, which absolutely blows me away. You know, as a beginner, when I started, I had zero knowledge. I had no idea what I was doing. I took a blanket approach by learning on YouTube and other places and stuff like that. What I found is that by slowly, steadily being consistent with the money that you put into the markets, picking an asset allocation that works for you and your risk, and then just being consistent, you are going to see your money grow. Now, if you're looking for someone to teach you how to beat the market, this is definitely not the place for you. This channel is all about helping beginners, and in particular, those that are later in life like me. So I'll just go over the accounts, and then you can use those chapters down at the bottom if you like. So I used to do updates on our kids' RRSP, but I've changed the format of the channel because I felt that some of the people that would be watching my content might not be too interested in it. I will start a separate series on the kids' RRSP, just giving some updates as we go along because it's been totally separated out, and I have a new strategy for the kids' RRSP at this point. So stay tuned for those videos if that's something you're interested, or check out my playlist. Okay, so let's talk about the Spousal RRSP. For those of you that are new and you don't know what that is, what it is an RRSP type of account where I make the contribution to it. I get the tax credit, and then my wife then takes that money out later in life. And of course, that has implications when it comes to the taxable amounts, because if the other person in your relationship is making a little bit less, or their tax bracket will be lower at the retirement stage, then you're going to be taxed less on that money. So you're essentially deferring some taxes, and you're getting that tax credit right now. So that's what we're doing. Now, the strategy that we came up with was not by accident, it was by design, because I had a meeting, a financial planning meeting, with a place called Enriched Academy, which is in the Lower Mainland of Vancouver. And through that, I determined that the amount of money that we were doubling down on our mortgage may be better spent by investing it. And so what we're doing is we're taking that extra money that we were putting into our mortgage, and we're actually putting it into the markets. So right now it's $43 a day. Now that sounds rather random, but all I did was take the full amount that we would have and divide it by every day. So we're taking $43 and we're adding it into our account, and then we're investing that. Now, initially, the way I started out this investing strategy was to invest it by building cash up, because I wanted to use the RRSP, which is a great tool to invest in USD and US stocks. And so I would build up about $2,000 and then convert that money over using Norbert Gambit. We all know that it's important to save on fees. If I was converting money every single day, the fees on that would add up rather quickly. So to avoid that, I allowed the money to build up as cash. But then I had this realization that by doing so, I'm not really doing anything with that money, but because I put it into the RRSP, there's not a lot I can do with it. Some people will put that type of money into like a high interest savings account and let it accumulate, then convert it in some way and then utilize it to become their investing tool at that point because they've already converted it in some other means. I use Norbert Gambit through Questrade. Now the strategy will be to invest that money into a passive income vehicle. And in this case, it's going to be a covered call. And the covered call that I'm going to be using currently will be HYLD. Now, because this is a community, I'm always open to ideas. So if you have something else you'd like to suggest, put it in the comments below. So basically, this is kind of like investing it into something like a GIC or a high interest savings account. The difference is there's a little bit more risk in this because if I go to pull this money out in the strategy that I'm using and that stock or that ETF is down, I'm then going to realize the loss on that. So that's the risk that I run. So what we're doing is we're investing $43 a day into HYLD. And then once we've accumulated another $2,000 plus the dividends, once they come back into the account, we're going to then take that money and then we're going to convert it and we'll invest that into our asset allocation. Now, if you're not sure what an asset allocation is, I did a video on it and it helps explain what that strategy is all about and how to utilize it and how passive becomes a big part of that, especially like I did when I built my asset allocation. So let's talk briefly about the whole notion of using Norbert Gambit. Now, there are a few different ways to convert your funds into USD. The one that I'm currently using is the Norbert Gambit. Now, there are other brokerages out there that offer different fee structures, but currently this is the one that I am using. Now, Norbert Gambit, when you use it in Questrade, they charge $9.95 for that journaling fee. When we look at the cost structure, it costs $9.95 with Questrade in order to do that. Now, recently Questrade made a change to their bundling or their packaging when it comes to some of their offerings. And one of the things that they offer is their elite version. And what that allows for is unlimited journaling for Norbert Gambit. Journaling and Norbert Gambit go hand in hand. The cost for that is $11.95 per month. From my perspective, if I'm allowing about $2,000 to build up before I need to then convert it into USD using Norbert Gambit, that's only equating to about 6 trades a year. And of course, if you had the unlimited version, you could do this unlimited, but I don't foresee that. So the numbers look like this. If I was to get the yearly subscription for the elite version with Questrade, that would cost me about $143.40 a year. Now, if you look at that, if I only do about 6 trades a year and I'm getting charged $9.95, that only equals $59.70. So if we're looking to reduce fees, in my opinion, if I don't use any other parts of the elite part of the subscription, it doesn't make sense if I'm just simply journaling. Now, if we step that out a little bit and we look at the entire year of 12 months, that equals $119.40. So it's still cheaper. Now, if you have a lot of money and you're going to be doing this consistently every single month or maybe more than once, then that subscription might make a lot of sense. So when we talk about my spousal account, the asset allocation that I have set up is pretty consistent across all of my various accounts. The difference is that in my spousal account, I'm holding similar ETFs in USD rather than in CAD. So that's the difference between my TFSAs and my RRSPs. Similar funds, just in Canadian funds in USD. And so the spousal account's 91% accurate on that asset allocation. There is some cash that's sitting in there right now. And of course, the nice thing about passive is it makes suggestions on what to buy. You don't necessarily have to follow that, but it helps me keep in line with the asset allocation that I've set up. Looks like we got about $36 in Canadian funds in there and $19 in US funds. Of course, those are from dividends. And then that's from also that $43 every day that goes in. The total value of that account sitting at $108,847. So it's growing because I started investing quite a bit into this particular account this year. And of course, that contributes to the total overall returns of everything. Moving right along into the kids' TFSA, like I said, we're using this to teach them. There's not any money that's been put in this one for quite a while, sitting at 94% accuracy. It only has a few funds in it. Again, it's a teaching tool for the kids. Only has about $17 in cash in it. And the total value of that one is $2,582. Then we have my wife's US side of the account. It's 97% accurate. Again, we're not really putting any money into this. The total value of that side of the account is $110,089, and it looks like there's only about $2 in US. So this one generates quite a bit of dividends. Again, it's more growth oriented than it is for income or passive income right now. And now we'll go into the metrics for the entire account so that you guys can see what this account in total generates as far as growth and the dividends and so on and so forth. We're looking at the overall performance of the account. This is where you bring all of them together in one place. So we're using passive. Passive, now this one's an absolute game changer for ETF investors because what it does is it connects your brokerage accounts. Like mine, I have them in several places. It brings them together from 2 different brokerages. And I can set asset allocations like I mentioned before, and I can actually automatically rebalance the portfolio and track all the dividends in one place. I don't have to worry about making any random trades or trying to time the market. So passive keeps me aligned with all of these long-term goals that I've set out. This is how I make sure that I stay consistent, like I was mentioning before, without obsessing over every single move that I need to make. I thought it would be interesting to reflect on the amount of money that I actually started with in order to get to today. So we have to rewind the clock a little bit to April of 2023. This is when I start my investing journey. And I really, honestly, I had no idea what I was doing. Again, I'd done some research on YouTube, started reading some stuff, but I knew I had to get started. And I think that goes to the notion that if you're waiting another day to start investing, it's another day of lost compounding and watching your money grow. The money that I'm about to reveal that started all this didn't come into the accounts right away. It actually took quite some time. I had to build up a little bit of confidence because, you know, moving hundreds of thousands of dollars around is no small feat, especially as an investor who has no knowledge of what the stock market is truly really about. The amount of money that moved eventually into all the accounts to top all this up and start with was $200,466. Now let's put that into perspective. So that was in April of 2023. Now, if you consider the fact that I've continually been adding money to this account at a regular basis, and then you add all of the compounding and growth in there, when you think about the total today at $367,000, I think this demonstrates for itself that this actually works. Again, I'm going to reiterate this. I am just a regular Canadian with no financial background. I'm simply trying to help others because I still can't believe that I made it to the age of 50 not understanding or knowing really anything about this stuff. And in that now 26 months, I've managed to build up a decent sized portfolio. Backed into passive here, we can see that the net change in the account is $367,000. Unfortunately, those are skewed because of those deposits. It says the rate of return is minus 94%. That is obviously not accurate. Leading up to that transfer, it was very consistent in the growth, and that's why I showed you what those numbers were, what I started with and what I got to today. Now, the dividends on this account are probably the most interesting part of this for me. Now, again, if you were income oriented, this would probably be a lot higher, but in a growth portfolio, which is the majority of the focus of my portfolio, this is actually pretty nice to see. So you can see here, and this is one of the nice features of passive, is we see all of the months since I started investing showing a nice steady increase in the dividends that are coming into the account. But we can see here that the dividends in this particular month of June have absolutely exploded. And some of you might think, wow, like what happened there? Well, the reality is that not every ETF or stock pays a dividend monthly or quarterly. In some cases, a few of them that I hold, which are some of the international markets, only pay out twice a year. And this happens to be the month that they're paying out. So it's a lot higher. The monthly average of the dividends that I'm getting is $599. Now, this is simply on a growth account. You know, my covered call portion are very small in this account, somewhere probably under the 10% mark of the entire portfolio. So if you were income oriented and you were, you know, in retirement, much closer to retirement than me, and you wanted to shift over to some other covered call strategy or other passive income, then you would be generating a whole lot more money than I am. For now, I like this because the unrealized costs will become realized as we get closer to retirement, and then the dividends will start to change when we flip over and look at more passive income at that. In total, in the month of June, We had $2,004 in dividends. Not too shabby for sure. So when you think about that, would that be some amount of money that you could use to spend on a regular basis if you had to live off of this type of portfolio and not see the principal of your investment start to depreciate, because there's still growth in this? If you take money out, if you're using it in the passive income mode, then obviously the amount of principal you have will slowly, steadily decrease. Now, if you're in retirement, that's probably something that isn't going to bother you too much. It'll just be the percentage or the amount that you want to draw down in retirement. Another great feature of passive is it tells us how much we've been saving, and here it's telling us that we've paid $390 in fees and commissions. Now, keep in mind, that's from the last 26 months, and I have tried to limit that, and I just told you earlier in the spousal account how we're limiting some of those fees to best compound our money. Of course, the part that most people are the most interested in is how much dividends in total we've earned. So we're looking at $16,420. That's a significant amount. So what that's saying is that effectively we're getting just over $1,000 a month in the entire time that I've been investing, because those dividends change. Now, when I said that we're earning $550, that's based on the current portfolio, because I have changed some of the funds over time. But basically we're earning just over $1,000 a month. So not too shabby for a portfolio like this. The original reason that I started the channel was to max my TFSA out. So that's like the focal point of the channel. The spousal account has become a new place to put some money to defer things as far as tax returns and retirement. But the TFSA is, for me, one of the biggest reasons that I started investing. And there's a good reason for that. The TFSA is such a diverse account. I love this account. So you're able to put money in, invest it in whatever you like, and then it's after tax dollars, and you're not going to get taxed on any of the growth. So that's one of the great features of this account. Basically, we're like halfway there to maxing this account out. Now, because I recently moved money over to Questrade and I wasn't very happy with them, I've started a new Wealthsimple account that we're putting our money in. And the combination of the two contributes to your total. If you're not sure about your TFSA amount that you have available to you, you can actually find that in your CRA account. So after your taxes are done, you can actually go in there. It'll tell you how much more room you have for the remainder of the year. One word of caution is it doesn't update throughout the year. It's only at the end of the year when your taxes are done. So you want to be careful, because if you do over contribute to this account, you can get dinged with extra taxes. So you need to monitor it closely if you're getting towards the end of the available amount. And that will obviously depend on how old you are. Another great feature is that if I need money right now, and if you saw my last video, we got hit with some pretty big bills that were rather unexpected. We're going to make changes obviously to plan for those in the future. So if you want to learn how to do that, you should check that video out for sure. But the nice thing is I knew that in the background I could take money out of this TFSA in order to help us with those bills and not realize any taxes from that. Now, it would affect the compounding over time, but that would have been okay in this particular case. And that's why I love this account so much. In Questrade, this account is 95% accurate. We have $8.85 in cash that's sitting in there with a total value of $61,634. So we have a mix of VFV, XEF, XEC, XIC, XEI, QQC, BRE. So you can see by the ETFs that are in this particular account that I have some diversity built into it, and it's based on weighting, and that's what you refer to as that asset allocation. So if we were to look, I can tell you that I'm invested in North America, in Canada, and around the world, and that's where I get some of that diversification from. Am I beating the market? No, that's not my goal. My goal is to be stress-free when I put my money into these accounts and watch them grow. Now, as I said, there is a little bit more focus on some of the covered calls. And one of the things I realized is that for passive income, and not to realize any taxes per se, is to have some covered calls in my TFSA that can generate me some income that won't impact the taxes. So I actually changed the asset allocation in here, And what I did is I underweighted one of the international positions that I have, and now I'm adding that to HYLD. So I've increased my position in HYLD, which is a cover call, from about 2% up to 5%. And you can see here that we have some room to make up. So as I add more money, we'll add to that particular position to bring that up into our asset allocation. And what that will do is it will increase some of our passive income. And what I'm thinking here is that if I needed some money from this account, I will have some of that passive income being generated every month, rather than that big spike you saw in the dividends when I get it like every 2 months, where I got like $2,000. So I want to start building up a bigger position in some passive income in this TFSA. Now, it's not going to overweight the growth positions that I have. Perhaps as I get closer to retirement, we'll start weighting some of that more towards maybe some fixed income and this type of passive income. But for now, we're going to slowly start building up some more of that passive income. With some of the limitations of passive, this enters where the other tool is that I like to use, which is Wealthica, because it connects all of my accounts and it shows your full portfolio in one dashboard. Now I can log in, I can instantly see my balances, my asset mix, gains or losses, and some of the historical performance. Now this is totally free, and honestly it saves me from consistently logging into multiple accounts just to check one thing. But the most important part that I like about it is it actually shows me the total numbers, which tells me how much of each position that I have. So here, for instance, we can see the total portfolio. Now I took this video slightly after I did the other one, so you can see that the total amount is actually a little bit higher. So sneak peek to next month. So the nice thing is with this is I can see the holdings, and that's the one part that I'm really interested in. And when we look at the overall view, my asset allocation is reflected in these top funds like VU and XEI, IEMG, AVUV, and so on and so forth. But what I found interesting when I used this tool is we can see here that TD Bank is sitting at the about $9,000, close to $10,000 mark, and it is a single stock position within my account. Now, it's doing very well, performing well, up $1,663, which is a 20% return. Now, I do know that TD is a great compounder over time. It's a big bank and it grows. But if you watch my previous video about switching over to EQ Bank and the reasons that I did it, it does make me lose a little faith in this. And I'm now beginning to wonder when I see this, whether or not the performance of some of the other ETFs that I hold might actually be better than this TD position, and whether or not I need to hold it. All right, I'm just gonna insert this part into the video here. I'm sure throughout this video, the lighting keeps changing. As a new creator, I'm not investing a great deal of money into the technology that I have, and one of them is lighting right now. Typically, when I'm filming, the light that comes in through my sliding glass door here provides me with enough light. But now that we're in the summer, the sun is on that side of the house often, and it's very bright, and I know it reflects off my glasses. I do have some lighting, but it's really not that great. And so as the channel grows and I earn a little bit more money, I will definitely try to invest in some better equipment so this stuff doesn't happen. But if you're looking for a way to support the channel because you do enjoy it, you can use a lot of the links that I have. For the vast majority of people, you probably have already done these things, but I do have a link to buy me a coffee. It's a way to sort of give back, and it will invest back in the channel, and then I can invest some of that stuff. Then I can invest some of that money into some of the things that I need to actually improve some of the production end of it. All right, so like I said, I'm going to look at trimming some of these single stock positions, and this tool here with Wealthica has definitely drawn my attention to the fact that this TD stock I think is a little too high within my portfolio, and it's certainly not going to generate me a great deal of passive income. Now, TD does pay a decent dividend on a quarterly basis, and right now it's paying $1.05 per share. So if you were looking for a, strong dividend growth type of stock, then TD is definitely going to be one of those. But I can get exposure to that through some other funds, and that's what I'm going to look into, whether or not there's a different fund. I do hold it within XEI as a dividend ETF, as well as XIC. So I think it could be a little overkill to be holding it as a single stock position, but I want to analyze that just to make sure that I'm making the right decision, because as you can see, with a 20% return, it is growing fairly well. And again, that's one of the nice things about Wealthica, is that on the far right hand side, you see that what the growth is on a percentage basis, where you saw some of the inconsistencies with passive. Now, that's not to say that passive isn't a good tool. It still is a great tool. I will continue to use it because I think that it offers a lot in combination when you use these two. Now, Wealthica, like I said, is free. I don't get any referral fees for stuff. So if you are interested in supporting the channel, you can use that Buy Me a Coffee link. Now, there is only one last thing that we need to talk about, and that is the covered call case study that I'm doing. Now, it has gone through some iterations over the last little while with me moving to Questrade and so on and so forth. Now, that is a standalone case study, but I can assure you that it's still going on. And I've restarted it essentially in Wealthsimple, and I will be having an update coming up very shortly. Now, if you're just getting started with your investing journey and you're not too sure about how to set an asset allocation up, which is an important part of an investing strategy, you should watch this video right here.